volatilities themselves give us the key levels, give us some massive key levels. And these massive key levels, of course, are things that we want to try and focus on and highlight. When we see the massive key levels, we start to know that there's going to be a matching of dealers with commercials, and that's where the commercials want to deal. Because obviously the big volume is with the dealers, not with the retail public, it's with the dealers. The other thing that the big commercials need is they need to find buyers at higher prices, and they need to find sellers at lower prices. And obviously if the dealers are buying at higher prices and selling at lower prices, that's the perfect location for the commercials to do business with. And we start investigating those areas for opportunities. We did a little example this morning based around the USO. We did an example based around TLT, SPX, GLD. I can't remember if we did any others, but we did examples around those markets. And we were able to highlight almost exactly the opportunities that we're presenting. When we start putting those into context, when we start putting those into ideas, trading becomes incredibly, simplish, but we can start to look for the right things at the right time, the right values, the right volume starting to appear at the right price areas. And the interesting thing was nobody was using it. It's a class we've done probably in the last couple of years. We've probably done the class 5 or 6 times, certainly over that period of maybe 24 months. We don't do it often, but we occasionally do it. And a lot of the times, what we generally as a rule do a lot of the times is we use stocks like XOM to demonstrate these ideas, because XOM is just it's a pretty active little stock, and it allows people to understand the process. But on this occasion, we did it on USO, we did it on, as I said, we did it on the big ETFs. And that allowed people to try and understand a little bit about why we see certain things at certain prices, why we see fast money reversals, why we see big volumes at certain price areas as well. Who's stupid enough to be a buyer at massive prices? Nobody. Nobody. The occasional trader, of course, the occasional retail trader, but nobody's stupid enough to buy at ridiculously high prices. And just because you see massive buying doesn't mean somebody's stupid. You see that massive buying because somebody's hedging. It's not a loss for them. It will be a loss if they don't buy it at massive high prices. And that's the volume we're looking for, isn't it? That's the volume. If we've got time, we did the class this morning. If we've got time, we'll do it again this afternoon if people have an interest in it, because as I said, it's one of those classes I'm reluctant to do, because obviously the response I got to the class this morning was that nobody used it. So all the classes I've done in the past have obviously been pretty much a waste of time. But we can obviously go back over it again. I don't want to waste a lot of time on it, but we can certainly spend 10 minutes or so going back over it again this afternoon, just so that people can look at it. And then if there is a genuine uptake on people using it, then we can obviously go back and try and find things for you guys to think about. Other than that, we've talked about short squeezes and long squeezes. And obviously based on the short squeeze and the long squeeze process, we talked about a pound trade that was setting up for the squeeze. We talked about how and why and all that kind of stuff. We'll certainly cover that, because that's quite important from a scalper's point of view. And when we see those short squeezes and long squeezes taking place, we start to add in the values and we start to add in everything else. The idea of the best short squeeze is pretty simple. 2 key components: volume and value. Same as volume and value, but it's the opposite to what we do normally for a fade. It's the exact opposite. We want to see trap traders at weak prices. And that's what you're trying to identify. You want to try and identify lots of sellers coming in at weak prices that simply get on the wrong side of the trade. And that opens the door to a very, very sizable move. And in some ways, those trades take us to that bond trade narrative, because what you normally think about bonds is right. The more short squeezes, the more curve there's available. It might not make sense to you just now, but the more we talk about the concept of short squeezing and long squeezes, the more you'll start to understand volume against bonds. Because obviously the more buyers there are in bonds, the more bearish the bond is. The more sellers there are in bonds, the more bullish the bond is. You may be saying, oh my God, wait a second, what? The more buyers there are in bonds, the more bearish bonds are, because buyers are obviously getting involved in bonds for a steepener. Sellers are getting involved in bonds because they're building a flattener, and the flattener is bullish bonds. So the more sellers there are in bonds, the more bullish bonds are. So when you look at that and you think to yourself, wait a second, here's a great example. The more sellers there are in bonds, and this is TSV, the more sellers there are in bonds, the more bullish the bond is. There's a great example of it right there. That buy trade went from, well, when you first saw it, the buy trade went from 30s up to a high price of 11s. The more sellers you've got on bonds, the more bullish the bond is, because somebody is doing probably a bond curve trade, which is the opposite to the outright trade. So that's what you've always got to remember when you're looking at bonds, for example. And this is a great example of what we were talking about short squeezes, for example. So if you're looking at short squeezes, this is what you'd have been looking for from a short squeeze point of view. So in terms of an outright, this obviously becomes a short squeeze as well, which makes that big buy side pop right there, which starts to make a bit more sense when you start seeing those ideas lining up with each other. So welcome in, guys. Welcome in. We've had a reasonably good, productive morning. I've liked the oil markets. We called it last night in the tweets. You'll probably have seen that. We did a bit of business on tweets. We talked about oil. That was one of the key tweeted messages we had for you this morning. And and the oil's been the oil's been outstandingly good, hasn't it? We tweeted out last night that we expected to see profit taking at the Brent Open. Well, isn't that interesting? Profit taking at the Brent Open, because that's exactly what happened, wasn't it? At the Brent Open, we started to see the buyers coming in. We knew what was going to happen. We already were aware of it. We were already setting up to take advantage of it. But we know there's massive supply, right? We said that they would probably buy up to what price? Well, if you don't know what we're talking about because you don't have maybe smart alpha, then of course you just have to look at what we said last night about the oil price to try and figure this out. So last night we talked about, this was the tweet from 10 o'clock last night. Oil, plenty of supply still visible. So we want to sell at higher prices, right? Still the best is to be on the short side. However, expect a dose of profit taking to test the 72s. When does the profit taking start? Well, you would imagine it's going to start when the volume starts, right? There's no point in taking profits when nobody's doing any business. So I expect the profit taking to start at 8 o'clock, right? So around about 8 o'clock, I start buying oil to take advantage of the profit taking. Around about 8 o'clock, oil prices started to buy off the bottom edges. We got a big rally for $1,000. Up to what price? Rennie's absolutely right. Up to $72 oil. To test the $72 oil, right there. It's already typed out, Rennie. Everybody already knows where the sell's going to come back in. Now remember, supply is still visible. So we want to go short at 72s, right? Is that what everybody would read from that little tweet? Tweet. Is that looks as if that's what Rennie read from the tweet. That you should buy the London Open, sell the 72s. Yes? No? Yep, so Rennie read it that way. That's the way I read it. That's the way I wrote it. That was the way it was meant to be read. As you buy from the London Open, if we've got the opportunity to buy the London Open, it might have been opening at 72s, in which case somebody's bought it in the overnight session. Well, so there's no trade for me to buy, is there? So I don't know that that's going to happen, but at the London Open, the price was down at 71s. So I know there's going to be a dod of profit taking to come in. So I want to be buying into that 71s and selling into the 72s. So I did exactly that. I bought the 71s. I sold the 72s. And obviously all I have to now do is go and collect the paycheck from the bank. It's so fecking unbelievably easy, isn't it? And it really is easy in that case. That's just a walk in the park. Super, super easy to make those bits of decisions. And when you get into that process and you start looking at the oil and you say, well, what did happen? Well, let's take a look. Why are we still very heavily on the supply side? Well, you can see it. Still massively supplied, isn't it? It's not even trying to hide from you guys. This is not something that you're looking at going, damn it, I should definitely be buying this oil because it's definitely going to go up by $1,000. The only reason we bought it because of the profit take, because we were coming into this key bracket level and we'd already seen a very, very big buy side profit take from the morning in the US. So we know that the Brent oil is going to do the same. Brent's going to do the same profit take. Where's all my barons? Just Rennie, is that it? Not that that's not enough, Rennie, of course, but is that it? Is that all we've got in terms of the oil trade now? Is just myself and Rennie, or is anybody else playing oil? This should all make perfect sense. So where do you think the sell is going to come from? Where do you think the sell is going to come from? The 72s, right? So why would we come away from the 72s? Well, because we're breaking through the 7150s, and it's the next wholesale price. It's not any more difficult than that. It's not any more complicated than that. It's not any more complicated. It's just simply that that's the nearest round number. It's not me doing something that's extra special. It's just bloody obvious. So when we come into the chart itself, we can see exactly what's diddling up here. We can see the prior swing high. We can recognize the overnight swing high right there. We can recognize my buying in the London session right there. We know where the buying's coming in. Beautiful. So there's the buying for the profit take. There's the first swing high there. We start moving through the brackets. We can start to recognize the brackets. We can start to recognize the moves as they evolve. We can start to see as they go. And then we get this last flash to the upside. And obviously that comes up to 71.95. And obviously at that stage, we're starting to ask some questions, serious questions. The CAD yen was getting sold. The CAD yen was getting sold on this last leg higher. You've got to be thinking to yourself, oh my God, that's ridiculous. It is ridiculous. I'm going to be starting to sell this all the way through this process. So that is my sell area. Not one price, an area that I'm willing to sell maybe 25 to 30 ticks deep. I'm willing to sell anything that comes up into this area because I can hedge it against a CAD yen long if I wanted to. I could hedge it against a CAD yen long position. And obviously that's exactly what somebody did because somebody bought a lot of CAD yen and sold a lot of oil. I'm surprised to see that Cliff wasn't involved in that little fella right there because that's got a Cliff hallmark written all over it. Selling oil and buying CAD against that for a hedge. You can see what happened. The hedge met in the middle. And then when that hedge unwound, the oil price collapsed behind the hedge unwind. So you can see that the hedge unwound in this area here. You started to see the sellers coming in at the same time. You thought to yourself, right, that's the hedge unwind right there. That makes sense because that's about that halfback trade area there. That would make sense. So anybody that bought the CAD yen, closed off their CAD yen, anybody that sold oil, took profits on their oil, and then the whole flip took place and we started to make the big break south. And you can see that sell-off in line with the CAD yen selling. And why is that so fast? It's so fast because there's no hedge in it. As soon as you take away the hedgeability of that trade, and there's still the macro involved, remember, on the calendar spread, but as soon as you take away the hedgeability on that trade, there's no buyers out anywhere to be seen. It's just a straightforward sell. It's a beauty. It's an absolute rip-roaring success, and we've now gone from $72 to 70.5. $1,000 on the way up, $1,500 on the way down. My God, it's going to be another enormous day on oil. And only myself and Rennie are taking advantage of it. Tim said he sold some oil earlier. Michael, I don't know if you've got any of that trade, but this has been the best market by a country mile for quite some days. This market has been unbelievable, and I am not leaving the side of oil anytime soon, guys. There is huge downside value in this. Still huge downside value. And it's something that we've been, we've been talking about, we've been suggesting. We talked about it again last night when we said that the massive sell side value is still in place. Supply is still visible. The valuation on this oil is still lower. And we've just got to keep plugging away at it. We've got to know how to plug away at it, though. We've got to try and make sure we're in that short trade when we get that amount of value. When we get that amount of value, we don't have a choice. We are mad insane if we don't get back into the short oil trade with that amount of short value attached to it. When the inflation break-evens guys showed up this morning, and we asked them what they were doing, they didn't have a particularly clear idea about what they fancied with this. They were kind of in line with fair value. So they weren't telling us not to sell it. They were just in line with fair value. So there wasn't a trade from the inflation break-evens. When we're looking at the dollar, of course, one of the things that we know in terms of the dollar is that the dollar has been weak. We can see this dollar weakness. And that's the reason why we're able to get that higher price. And that's one of the reasons why we knew there was going to be a sizable profit take. The sizable profit take, because the dollar is actually relatively weak. There's going to be buyers of the underlying at these lower prints. But this has turned out to be unbelievable, guys. And this is just ripping like crazy now. This is just ripping like crazy now. Look at this, guys. We've just done $2,000 on the way down. Massive wholesale price level here, guys. Massive wholesale price level here. Taking a bit of money. 2,000 on the way down, guys. 1,000 on the way up. That's a $3,000 swing on oil from a tweet from last night. We even gave you the price. Rennie seen it. 72. 72. It was in the tweet, Skim. It's not hidden from you. Now, it didn't run the 72s, unfortunately, because the buyers gave up. The buyers just says, what the hell, I'm not going to buy at that price. And we started to see the big drop-off in the volumes. You can see the big drop-off in the volume just here. You can see that from the time segmented. So the volume was starting to run out of any interest in those higher prints. If you look at the OBVs, you can see a very, very sizable OBV divergence on this retest up here. And your question about whether we should be trading in this area when there's that amount of a divergence in volumes, the answer is damn right, because the commercials are going to have to sell on a downtick. Commercials are going to have to sell on a downtick, and that's exactly what they did. They sold on a downtick, and we took advantage of that, and that gave us this crashing market through these legs here. Absolutely crazy, isn't it? Absolutely crazy. But it was ready, it's primed, and it's just a pity we don't have more than one trader involved in that $2,000 sell-off. It's not hindsight, Paul, it's in the tweets. Selling off the 72s with supply still visible after a buy-side profit take. It's in the tweets. It's visible to every single person. And you can see the sell off the high prints for $2,000. Now, obviously you can start to recognize the bracket, of course, the big bracket. But it doesn't take a genius to recognize that it's $1,000 up and $1,000 down, does it? So it's not exactly something that you would have been struggling to come up with yourself right there. It's $1,000 up, $1,000 down, and total value size in that one is $2,000. Do you go into these trades knowing that it's going to be 2,000? Of course you don't. Do you go into those trades knowing how much value is in that short trade? Of course you do. And that's what we took advantage of. We knew exactly how much value was in the short trade. It was enormous. It might take you the whole day to work on it. Sometimes it takes you 20 minutes. Sometimes it takes you 5 minutes. But it might take you the whole day, and we're willing to do the whole day if that's what it takes. We're willing to do the whole day working into that trade to take advantage of a trade that looks like this. On a macro scale basis, it looks like this enormous opportunity to make an absolute fortune on a macro scale basis, just the same way as it was when it was away up at $75. and we got that huge sell-off, and then it's back up here, and now we're seeing that sell-off. Now, if this valuation is right on the calendars, this oil could be $66, guys. That's the opportunity, right? If this calendar valuation is correct, the oil could be priced as low as $66. It's currently trading at 70. So we have a potential $4,000 of more downside room for the rest of this week, unless something changes. It doesn't always do that. Of course, people might start buying the calendar spreads. They might start buying the calendar spreads against this as an idea, and that's going to start putting some bids into the oil markets. But we'll see it when it happens. If it happens, we'll see it, and we'll be able to take advantage in the short term. We'll just walk away, and we'll start thinking about the possibility of maybe buying some oil on some scalps. But the swing is never going to be a buy trade, is it? It's never going to be a buy trade. We might be able to do some scalp buys, but we're never going to be able to do any swing buys at all, possibly for weeks. Just the same way as there was plenty of buying opportunities, but this was all one huge, enormous sell proposition in here, wasn't it? This whole area was one huge, enormous sell proposition for the swing. Full $1,000 deep, guys. That's what the commercials deal on these big macros. And you can see that that outcome is absolutely superb. Anyway, welcome in, guys. I hope you're all good. You're all good this morning. We've certainly had a